Hello traders, Gary Wagner here just before 11 o'clock in Honolulu, 5 o'clock in New York on Wednesday, the 21st day of May 2014, and this is the daily report for gold and silver. After hitting a low this morning of 82.10, that's correct, 82.10, as the market seesawed as Fed information came out, we have the market well off of the lows, well off of really the New York market itself, only trading off about $2.60 right now, the high 97.10. Current print, call it 12.92. As I said, puts it off roughly 2 on the day. Silver unchanged, more on silver towards the end of the show. Traders, want to start today's show by looking at a 240-minute chart. We have had our support and resistance compression triangle that we've put in here. We can see that this market's been all over the board. Now, it is range bound. There's no doubt about that. We've talked about the fact that as we looked at this market, we had some real resistance up at around 1310 to 1312. That was our top primary point. Of course, 1300 to 98, that was another point that we were looking at. But when we look at that, you can see that that hasn't been as dramatic. What has been evident in the market and continues to do so is when we take a look at the most recent tops in the markets, the characteristic of these tops is the fact that we're getting lower highs. Now, the opposite is the truth when we're looking at these lows that have come in the market. This, of course, is about 421 here. This is a low of 470. We get a higher low here. Now, on this particular low, very subtly, but you can see we had yet another higher low here and another higher low here. So as this market has been moving linear in time, what we are seeing is we're seeing this market continue to compress, and we're seeing it continue to compress by virtue of the fact that we're seeing these lower highs and these higher lows. And so this market continues to compress in range and at the same time stay range bound. So it's an interesting market to say the least, but we are approaching somewhat of an apex of this triangle. Now, whether or not we'll see that result in anything is something we'll have to see at a future date. But here's the thing. With the equities markets raging as they have today, they reacted very positive to the words that came out of the Fed. The one thing that we're seeing is that gold is still pretty supportive. We had a dramatic lower trading market this morning as it was off, roughly $8-10. It's now only off about a couple of dollars, so it's really come back off of those lows. We can really see this market in terms of a sideways pattern when we look at our daily chart. And what we notice is as follows. Ever since this market, this is our first primary top. This, I believe, was 1391. This is the 1329. This is what we're pegging as our real resistance in the market right now. Of course, we have 1314, 1310, that area. That comes in as a fib retracement level. And then this 26 level at 1296 is not that important when we look at it through the eyes of the short term, but on one of our longer term charts, it's a weekly chart with multiple fib retracements. We do get our harmonics in this area. So for that reason, I have earmarked this as a pretty critical area, meaning just below 1300. And that's not based on this particular study, but yet another study. Now, when we look at this chart, it's quite obvious to see we have been trading within this defined range. The range that I'm talking about is 1274 on the low, on the high 1314. So it gives us roughly a $40 range. But the bulk of that range has really been kind of concentrated to the center first. The second characteristic that we've talked about is that we have a multitude of days in which we have these very small bodied candles, meaning they're opening and closing at roughly the same area. And at the same time, they are trading with a very narrow high and low. Now, we have a market that is compressing because, as we've talked about on the last chart that we just looked at, we've had a series of lower highs and higher lows. When we look at it just in terms of a straight daily basis, what we're getting is really linear action, sideways action, as this market continues to trade in a range-bound manner. So traders, I've brought up our weekly chart that I just spoke about, and this has a multitude of different fib retracements. They really start from different lows. They all move up to this high, and therefore what we look for is harmonics. And as I mentioned, you have a 50% at 1292 and a 61% retracement at 1296. That's what creates those harmonics. Harmonics is simply where two different cycles agree. And it's interesting because what we're seeing at this, I believe, to be a pretty critical area in terms of numerics, rather than any kind of action, we're really getting the market kind of moving, gravitating towards the center. So what we see is that when the market has been trading higher, it has gravitated right to this area. You can see that right here, as opposed to going straight through it or straight above it. And what we're seeing right now is the market genuinely tracking sideways. Now, we've talked about the fact that we have seen this kind of sideways activity very rarely in gold. And that's the whole thing. We have been really focusing on gold for the last 5 years. And over that period of time, we have seen dramatic spikes. We have seen dramatic falls in the market. We've seen the market, even when it traded sideways, and I draw your attention to the area where it just came off of above 1900, 1920, and then began to oscillate between 1800 on the high side, and then about 1534, these are 1534, I believe, were our lows. So what we saw was, yes, the market was trading not sideways, but it was range bound, but the range itself was almost $300. And so that's a completely different type of scenario. Now, where have we seen the market bunched up? And we talked about this a little bit. You can see that it comes straight down, goes straight up. You get that bunching right in here. There's no doubt about that. The market finds this kind of a base and a bottom. It trades off of it, and it's right before we get this dramatic spike up. So we have seen it trade effectively in a sideways pattern and then really break fairly hard. Is that what we're going to see, or are we going to see more of the same? And that's why for the market forecast yesterday, what I titled it was, is this quiet before the storm or quiet before the quiet? We don't really know, and we really won't know until the market actually unfolds. My sense is we will see some sort of dramatic break at some point, and that dramatic break, of course, could be down or up, because the break that I'm looking at is based upon a compression of range and not so much activity within the market. But this market, without a question of a doubt, still remains very, very supportive at around 75 to 80 and has dramatic resistance starting at 1309, 1312, then again at 1330. Now, as we look at silver, the one thing that I have noticed recently is that we have had also this series of higher lows. We have certainly had a flat top in terms of its resistance at around $20 per ounce. Very, very different than when we look at gold, because gold's really had that flat bottom more than silver has, although it has the series of higher lows. It's been trading within that narrowly defined range. These higher lows are only higher by $7 to $10. And on the upside, we've had a dramatic set of lower highs. We're not getting that in silver. What we are getting in silver is more of this congestion as it trades sideways. Without the market trading above 1958, I cannot be bullish on the market. That would be the point that we would have to find support and see the market move from there. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow on Thursday for another daily update and review. Bye-bye.